Drew Meredith, hey,
Very, very good. It feels like nothing's happened the last week or so. It's school holidays down in Melbourne, and been spending a lot of time with the kids this week. And it feels like, market's just cruising along as they normally would.
Yeah.
Is that, if you haven't read the newspaper, would that be about right?
Yeah. So if you've got kids, you don't actually know that the world almost exploded. Just kidding. Maybe not.
Pretty close. It did start the week before, in my defense, didn't it? So I got no excuse for that.
Yeah. Over the weekend, the futures, which is a fancy way of saying what people expect is going to happen the next day, were down like 4%.
Looking into the future, yep.
Yeah. We're down 4%. And then the market fell 6.5%. So, but then it recovered to end down 4% on Monday. Tuesday was a good day-ish. Wednesday was a bad day again. And then today, Thursday, we're recording at midday. And the ASX
flying.
What's it up
and
right
you might
now?
have had a little humble brag of your own, which, have you heard of an early crow? I felt like that could have been a bit of an early crow. An early crow when your team's winning in the second quarter and you're up and about.
Well, overnight,
one day of trading.
Overnight, the S&P 500 went up 10%. Nasdaq up by 12%. Oh, there's a photo of Scott Phillips on my screen when the Motley Fool. And it was fascinating. Yeah. So Drew, I think, a bit of a humble brag. I created
public humble brag.
I created very public humble brag. I wanted to give people confidence. I invested another $100,000 in an account within our Rask Invest platform. And the thing is, because it was a new account for one of our bucket companies, I set up the account last week, but the actual investments and the clearing and the money laundering, like ID verification.
The money laundering testing, not the money laundering.
I wasn't money laundering, but I was being checked for said money laundering.
Fair enough.
As part of our, they call it AML and KYC.
You never know about these influencers and podcasters, do you?
Yeah, you never know. These podcasters these days, honestly, can't be trusted. But anyway, finally, the money got invested and it wasn't invested right at the very bottom, but the money was invested like at very primo prices.
Intraday.
Drew. So I was just joking to you off air that I've wanted to build an outdoor studio. And so I was thinking maybe I'll just take some of my profits off the table and start building that.
Pay your tax, of course. Pay your tax after that.
Tax?
Yeah.
Maybe.
That's amazing. Well done. I mean, there was a lot of...
what they say, it's not about time in the market, it's about timing the market.
Yeah.
And if anyone wants to buy my new technical trading strategy, it is available on Discord only.
$1,000 a week.
$1,000
Mary Louise Walsh.
Yeah, and
that's the YouTube channels. That's not an actual person. Just put it out there.
Find me in the YouTube comments next to Bitcoin and all the other things that make no sense.
Were you planning to put that money into the market though, and did it just trigger you to do it?
Yeah. So that's one of the things. So we were joking. The timing the market is impossible. But one of the things that was going to happen is I was going to put money in anyway. More than that, as I said to you off air. But what?
More than that? Oh, that's another humble brag. Or is it a flex? That's a flat out flex.
Maybe. I didn't want to come across as arrogant, but it's probably the single biggest one-day lump sum I've personally invested. But I refinanced our house. So that's important to understand. It's like we use an equity release strategy at Casa del Rask. So we effectively, anytime we get equity in our home, we withdraw that money and then invest it.
Put in cash, yeah.
And the reason that we do that is so that the investment money that we put in, the interest on just that component becomes tax deductible. And this isn't for everyone. There are risks and so on and so forth. There's debt recycling, which is very similar, but the actual loan amount stays the same. What we do is equity release, which is where our loan gets bigger. So some people think that's risky, and it maybe is, but it works for us. And we were happy to do it. So that's been good.
What are you going to do if it falls another 20% from here? Basically, we've got a 90-day hiatus off for negotiation, it seems like. But it doesn't feel like Trump's going to stop this even after 90 days. Not to say he couldn't, 3 days later say, actually, we're going ahead again.
Yeah. No, I mean, Yeah. So he's kept the tariffs on China at the time of recording. I got up really early. I was up at like 4 a.m. this
Yeah,
morning.
congratulations. I don't think we've done it on air yet either.
Anyway. Thank you. Yeah,
To Sarah and yourself.
Charlie Munger 2.0 was born 2 weeks ago. So, he's a little legend. And his investment portfolio actually starts this week, Drew. So,
2 weeks too late.
2 weeks of lost compounding.
It's really interesting that Derrimuth got a ring in there too.
Yeah, well, Charlie Derrimuth Rask.
Yeah, named after the future Reserve Bank governor. Governor.
Shine your boots. Yeah, now he's a bit of a bad omen on the markets at the moment. But or maybe he's good. Maybe it was his doing that forced me to put that money on Monday.
Turn the market around.
Yeah. But no, yeah. So I was up early this morning listening to US President Donald Trump talk about the wind back of the tariffs. He didn't call it that, but basically every country or economic bloc like the European Union, every tariff that the US had previously announced is dropping back to a fixed low rate, and China's going up.
To 100%.
Yeah, to basically infinite amount. And effectively that's had, in my opinion, it's going to have two massive consequences in the short term. One is China's going to flood the world with cheap products that would previously have been going to the US. Secondly is that the China's hiked everything on the US as well. So
reciprocal.
I'm curious. I know you've been buying something yourself this week, which we'll come back to. But I'm curious, like,
probably got that just in time.
Why do you think this happened? Like, why do you think Donald Trump? I know everyone's got a crystal ball, but why do you think it's happened?
I think, you wrote a pretty well worded hypothetical almost about this to your members. I think, Trump's always, and there's no surprise, he did use tariffs last time as a massive election tool and as also to negotiate the relationship with China. I don't think anyone expected to be the scale that it was. Basically, the penguins got taxed, Norfolk Island got taxed. But it's the way Trump negotiates, I think, but it's incredibly obvious. And it's a very blunt tool that they're using to do it. But China, a lot of other countries have been importing deflation or effectively taking money out of America, and America's not that they'll be able to turn around in one term of government, but manufacturing in all the traditional areas of America have died. They probably died for good reason 10 or 15 years ago, and all the traditional types of jobs have been disappearing. And I think I don't think it'll go as far as everyone's worried about. I think it was a lot deeper and harsher than what everyone expected. But it's basically Trump, I guess I'm assuming has the support of the Republican Party at the same time, trying to renegotiate trading terms. Every country adds subsidies and supports different industries that they know are important to their own country.
Luxury car tax?
Australia does it. Yeah, luxury car tax. But then we also do, interest-free loans or very low-cost loans to certain parts of, I think it's agriculture. It's obviously a big part of our export. So, and this is, I think you probably need more nuance, and that's where it's going at the moment, rather than just applying a flat tax to everything. Yeah. But it's basically more and more, a deficit for America means more and more money is going out of the country and not being invested in the country. And Trump's ran on this idea that people would build more in America, spend more money in America, and invest more in their own country. He's the biggest business in the world are all American, and they're getting money from every other part of the world. But you only have to look at it from one side. So it's just a like trade terms, I feel like they just drift along. Like they weren't even a topic of conversation for the last 10, 20 years, really, apart from China. And it's just kind of been a free-for-all. So it's kind of a reset. Who knows where it ends up? And that's why my concern would be that this is like, if you think about a crisis, the global financial crisis, it felt like this for like 12 months in a row. It wasn't falling 6, 7, 8% every session, but it was like down, 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 down. And I think it went from like 7,800 to 2,000 or 3,200. And you can imagine this is like 2 or 3 days and the whole world was freaking out, as lack of a better word. Yeah. And then it turned around incredibly quickly. But I think it's also the nature of how markets work these days. But yeah, it's I think it's putting a stake in the ground, trying to renegotiate terms and trying to import some wealth, I guess, back into America.
Do you think young Betty and George, growing up in US elementary school, want to become coal miners?
I wouldn't think so, no. Well, this is the problem. Like you say, you got $3 trillion to people of commitments to invest in America. But that's not, it takes 5-10 years to build anything in Australia, let alone America. You're going to build chip manufacturing. It's going to take another decade. So it starts a process that'll probably be, cancelled halfway through when another government comes in, unless Trump also manages to change the constitution. But that's the thing. The tariffs are very short term to try and attract more money to the US, but the investment has to take place over decades. They got dwindled over many, many decades, and now it's starting a trajectory where the US becomes the home of everything again. But it's also much more expensive compared to a lot of the other countries in the world.
I remember, you go to the US 10 years ago, or maybe not 10 years ago, but say 10 years ago, and literally everything's made in the USA. It's different now, right? There's a lot of made in China and stuff. And you could spin this anyway, right? Obviously, I believe that this is my 2 cents, is that Trump's living up to his true belief that he is trying to make America great again. But the problem is it's coming probably 15 years after it should have, to get a sufficient ROI.
You need to pause it when it was happening.
The free trade agreements that they had in place were obviously probably to the betterment of humanity. It's probably fair to say. The world is richer for America's generosity over the past 30 years. But ultimately, you look at some of the decisions, how is putting a tariff on Australian products in any way going to help us look more favorably upon America versus China? Yeah. It's not. Same with the European Union. The great shame, I think, Drew, is that if you look at the super economic powers around the world, really the US is the one that has the most truest form of democracy, which is you have a president or something come in, they get 2 terms in office, they do their thing, and then they go. Whereas you look at the 100-year economic policy of China and President Xi basically looking like he could stay in forever. You look at the likes of Vladimir Putin in Russia, they're not necessarily what everyone else on the outside in the Western world associates with probably a true form of democracy, more draconian and these types of things. And there are a lot of American ideals that have been exported either through Hollywood or technology or manufacturing or just anything or culture over the past 100 years that have definitely been for the betterment of humanity. So it's going to be really interesting. I'm still a firm believer when it comes back to investing that personally, I actually think that no matter what happens, it is 100% in America's interest, economically, socially, defense-wise, politically, to absolutely back American companies.
Yeah.
Companies
reduce reliance on
Apple, Google, Microsoft. Forget tariffs. They should just be pouring stimulus checks straight into those organizations because those are the things that dominate the world.
Yeah.
Sure, American defense is unparalleled at the moment. But we've talked about this before. Basically, Microsoft is the size of 50 countries combined. And so if you just kept on helping them control everyone's...
Swallow the world.
Just control everyone's... And by everyone, I mean every country's technology backbone, you're going to be fine. So it's going to be really interesting. But in other big news, Drew, I think I have a photo to show the good people.
I don't have a photo yet. We'll have a photo.
No, I do have one. I have a photo here that I can share with the good people.
You've edited this, yep, community. Of course.
Do you want to describe what is happening in this photo here, Drew?
Is this? Oh, this is my children in the backseat of my car. Is that what it's supposed to be? Yep.
Drew has himself a new vehicle.
Yeah, with 3 wheels. A trike. Is that called a trike? What do you call that?
I have no idea, but it looks like it's from England, so it could be
World's smallest car in 3/8. He circumnavigated.
Mr. Hawken, who is a 5'11" tall man, had to drive with his knees jammed in the side of
That's
the
like
wheel.
me in any car. I'm not even tall.
So anyway, back to the real big news. There was, for people that are just tuning into the Australian Investors podcast, there was big news out at the beginning of 2025 that Drew Meredith had to make the kind of landmark decision of whether to go with a Prado or a Tesla. And we finally have a decision, ladies and gentlemen. What can you reveal to us today, Drew Meredith?
I mean, Elon Musk was on the nose this year, so I made the decision quite easily, quite much easier than I ever expected. But you're going to be the proud owner of a 2025 Toyota Prado.
Wow.
And my father provided some sage advice, maybe sage advice, maybe also potentially inappropriate, but it was only buy Japanese and Korean cars at the moment. That was his advice.
And why is that?
They're
Drew?
the most reliable and easiest to get replacement parts and those sort of things.
Probably. Wait. So what do you? So you're saying you're going on this whole trade tariff thing here? Is that the narrative that he was pursuing?
No, just in terms of the ability to, the reliability of these cars and the amount of history they have versus, not saying there's anything wrong with some of the new brands that are coming out, but they've only been operating for 2 or 3 years. Versus, Toyota, I couldn't even tell you how long Toyota's been around. It's the white one.
Are you going a white one? I thought you were going black.
Yeah. No, I hate black. Black cars get dirty so quickly.
That's true, they do.
They've got to get, the snorkel doesn't come with the car, so unfortunately, won't there be no snorkel
Wow.
along with it, but and making a trek up to your home ground over the weekend as well, which will be exciting.
Yeah, you're going up towards King Valley.
Come say hi in the King Valley if you see me.
Up past the Wangaratta region here in regional Victoria.
Notice the retirement guy up, I think.
Yes.
But the white one with the white handles too, not the black door handles.
Wow. So you
Let's not show the prices on here. That's fine.
Wow. So this is cheap. This is 2024. Absolute Terry tight asses, as they say. This one's only $92,000, Drew. So that's great. Good on you. Congratulations on your purchase. As someone with a Tesla, I must admit I am disappointed that you have contributed to.
Well, there's every chance there'll be another electric one, but I got to get the 4-wheel driving and that sort of stuff out of the way and be able to tow the jet ski. And
well, as we know, it's very.
There is no jet ski. That was. Let's be clear. Not that there's anything wrong with jet skis, but there is no jet ski.
Okay. No, we do know that Prado owners are the number one jet skis in Australia. So it's only a matter of time, ladies and gentlemen, before Drew is doing burnouts in front of your peaceful beach.
Will never happen. Not that there's anything wrong with that.
So in other news, let's do an update on the community portfolio.
No, please don't. We don't need to do this.
No, we can. What am I doing?
I don't think we need to.
Here we go.
Is this live though? Because
no. This is not live pricing.
Tesla's up 22% today.
So at the time of recording, S&P ASX 200 4.6% up. But at the beginning of January 1st.
Oh, you have to go my portfolio first.
Pardon me, I'm drinking a Pepsi Cola. So Navexa scoreboard, use Navexa to track your portfolio. Navexa.com for portfolio tracking and unlisted assets. So anyway, Drew designed his portfolio, everything, named after the eggs seasoning, currently down 11%. However, Drew, Navexa updates our tables end of day.
Okay.
So that would be 4 or 5 p.m. today. It's not current pricing. And as I just said, a lot of those markets are up. You said Tesla's up what?
22%.
Well, here it shows 32% down. So you would actually be significantly in the positive, like in a bunch of these positions by the end of the other. Because overnight, for example, if we switch to the Dizzy Rascals community portfolio, currently down 5.7%, but also winning.
This portfolio is beating us.
This portfolio of what we would call a medley soup of stock suggestions is KKR, which was the winning stock across all three portfolios, was up.
Then it wasn't.
7%, then went down 25 to like a 50% reversal to negative 25%. This one stock, this private equity company listed on the New York Stock Exchange, rose something like 18% overnight. Yeah, 17% overnight. KKR went up, which is just absolutely wild. It's been a big year. So there's that. Now, if we turn to my blessed portfolio, which is kind of like in the middle.
It's amazing even with this, like I'm down 11, you're down 9, and that's down 6 or 7. That's not actually, given we all started on 1 January versus most people in the market have been in the market for a while, which means you're not even down, you're still up significantly. Yeah. It could be a lot worse. There's also, I get a good reminder here that the difference between holding and the risk of holding direct stocks. So I got 2 that are down over 20%. KKR was down 20%. You've got a couple. And then you look at the funds, and they're generally going to be much more, fall less. They're more diversified, and that's why I like those going into mid and small caps anyway.
Yeah, definitely.
You got to learn something from these situations.
Yeah, RPM Global, which is one of my faves, software company that does, it works with mining companies for mine sites and productivity enhancements and things. That's down 16% for me. That's my second worst performer. My worst performing investment, as you can see on the screen in front of you for those that are watching, is down 26%, and that is GGUS, the mighty GGUS, a bold call, which is approximately a 2.5 times leveraged US stock market ETF that I decided to buy for this fake portfolio. However, Drew, because it multiplies the return of the stock market and the S&P 500 went up around about 9.65% overnight, my beautiful GGUS is currently tracking to be up in a single day 23.4%.
That's disgusting. There was an article
these
about...
These are silly portfolios. We should say that. These are not real portfolios. Disclaimer is general advice only, but these are definitely not our portfolios. Speak to a financial planner before you make a decision based on a Rust podcast.
And if they recommend this, don't do it.
If they recommend our portfolios that you see here on the screen, these fake ones, yeah, run away. But that's good for me. And FANG, 10% FANG is up today. I was thinking of adding FANG to the Rask Invest portfolios this week. Ouch. Anyway, FANG.
I mean, it is amazing. And you don't see this type of environment very often where everything's going up or down by 10%. I did see there was an article during the week that talked about, I'm not sure which trading platform it was, so I won't try and make up which one it was. But there was a comment about the stocks everyone was trading. So people were buying, the most volume was in IVV, I think it was CBA, and then in the leverage short on the market.
Oh my gosh. Is that like SNAS? I think that's SNAS.
Yeah, or something like that. People had gone into that. Apparently, that's where some of the highest volume was on one of the low-cost trading platforms.
Gosh.
Yesterday and the day before.
So GlobalX, sponsor of the Australian Investors Podcast. Love the team at GlobalX. They also provide the FANG ETF.
Yeah.
But they also provide this ETF, which is the GlobalX
2.5 times short
Nasdaq 100 complex ETF. Looking here on the ASX website, is down 23% in one day. I mean, shiver me timbers. That's the official party line.
He's leverage in any direction. Like your tendency is when it's falling, you're like, all right, yep, I should leverage it up. But if that fall became a 20% fall, then you've lost 45% once you bought it. So that's always being able to understand that and also give it in context to your situation. Is it, can I live through this one and be completely fine afterwards? If it is yes, then it's like, well, you can get enough leverage out of buying a discounted S&P 500 than a leveraged S&P 500 for a lot, depending on each person though.
Yeah.
That's why I think sometimes we get a bit excited and go into leverage things when we don't necessarily need them.
We don't, and that's a good point. We don't use any leveraged ETFs at Rask either. One of the things to keep in mind is that I said before that I redrew money out of my property, which is a leveraged strategy in a way. It's gearing. But that's very, very different to investing in something that's so volatile. One of the things that's worth noting, actually, I put this in the community earlier today, Drew, which is that yesterday on the scorecard, on our Novexa scorecard for my portfolio, the fake one that I've been running, that was down 26% GGUS. And then today it's up 24%. What people don't understand about leveraged ETFs is something called volatility decay. So if you think about, let's just take a normal
investment. So you won't be back at zero after that.
you wouldn't be back at zero. So if like you're at $100 and there's 2 times leverage and you fall, say to $80, what happens is the leverage resets, right? So in order to get back to $100 from 80, you need more than the 20% return, but the leverage isn't the same. So one of the things that happens is over time, incrementally, you will lose money from volatility decay if it's really, really volatile. Obviously, if the stock market goes straight up and you're 2 times levered, then obviously you're going to retire early. But the reality is that's not how the stock market works. It bounces around, and particularly at moments like now, whether you're trying to use leveraged long or short, like you're betting with the market or against it, very, 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 very risky. I wouldn't be, no offense to that inverse leveraged ETF. But I think of those inverse ones, the one that go the opposite direction, or the short ETFs, the ones that bet on the market falling.
Yeah.
Like Bear and BBOS and SNAS and all those things. I often think, Drew, that if you're using one of those ETFs, it's because you think it's kind of like Armageddon in the stock
really
market.
coming, yeah. Or you've got a big position in like one stock.
Yeah.
That's 90% of your wealth, and you're worried about hedging against that.
But if you're betting against Armageddon, I would never put my money in a stock. Like if you thought the world was going to blow
I'd be buying
up,
baked beans or Pokemon cards.
Yeah, Pokemon cards. Don't put it in a derivative-based ETF that could have
100%
party risk.
It's got to be portfolio hedges or like a short, because it's 100% time in the market. So you're providing a hedge against all the other equity risk that you have, but you're actually enhancing risk or adding more risk to it, or you're trying to time something. Which, as we've seen this week, not many the market wouldn't have sold off enough as much if people were prepared for what happened. So no one was prepared for what happened.
No. The one thing that was probably a little bit troubling, which some people say spooked Trump into taking some action finally, was that bond prices reversed. So
yields actually went up, didn't they?
Yeah. So for people that don't know what that means, is normally during uncertainties, bonds kind of hold their value, particularly American bonds.
Or increase, yeah.
Yeah, or go up. But they actually went the other way. So meaning that they started to fall. And the reason they started to fall, allegedly, is that the flows and the massive like pension funds and all these types of things started to get rid of them in the United States and sovereign countries like China that buys US debt was no longer buying. So it was the market was kind of in a state of massive uncertainty.
They started to sell to go to cash.
Exactly. But one of the things you might remember, Drew, is like, I think it was like 3 years ago, maybe it was 4 years ago, when we had an inverted yield curve, which for people that don't understand what that means, it basically meant that, from my understanding off the top of my head, is that longer term bonds were safer than shorter term bonds. I'm trying to think about what an inverted yield curve looks like off the top of my head. Effectively, this tracks the return that you would get from bonds if you had lent money to the government. And what it showed is that what the bears were saying, the people that were negative were saying, was that effectively when the bond market turns on its head, a recession almost certainly follows that. And I think this is a big mistake that a lot of investors make, amongst the many that we always make, myself included, is that we confuse correlation with causation.
Yeah.
We think, well...
Can you explain those concepts?
Yeah. So in finance, I was actually thinking about this. People make these correlation mistakes all the time.
The media starts with it too.
Yeah, because it's like, in 7 of the past Tuesdays, the stock market has fallen 7%. Therefore, this Tuesday, the stock market will likely fall 7%. It's like, no, that's not. It's like, how many left-hand turns do I take to get to a cafe? I'll just do that. It's not how the world works. Correlation versus causation. Correlation is like, well, historically, the data suggests that 2 different investments move in the same direction, don't move in the same direction, whatever. But causation is actually the difference that does that one thing actually affect directly the other variable. And people think that just because a chart does something, that something else is going to happen. And it's such an obvious mistake that people who don't understand the difference between causation and correlation get wrong. And a lot of investment consultants get this wrong for what it's worth. Like a lot of professional investors will rely on correlation but not understand the causation. So
in crisis, all correlation goes to one.
Yeah.
That's what we've seen each time.
GFC, we thought, well, bonds go the opposite direction to shares. Therefore, we should buy bonds in the GFC. Well, bonds didn't do that, and everyone bought something else that was falling. So it's really important to understand this concept when you're building a portfolio. Like we've seen gold recently, Drew. Like we have bonds at Rask, and they've gone up, but they haven't gone up that much.
Not significantly, no. But they provide a protection. When a market's falling 10%, they go, even if they're flat, they've done their job.
Yeah, they haven't fallen, which is great, but they haven't gone up. Not like gold, which has gone way up. So you've got gold, right?
Yeah, we've had gold for a long period of time. I think we bought it back at $1,700 an ounce in Aussie dollars. So it's like more than tripled. One of the most difficult holdings to recommend to clients. At the time, there was just a tendency, and still is, we recommend it still, that it doesn't provide income, so why would you own it? And now it's become obvious, and with proof in the pudding now, but now the question becomes, what do you do from here? But a lot of advisors, so we had people that worked in our team no longer working with us. Not that was why.
Damn you.
But they refused to buy gold. They're like, oh, I can get 4% dividends out of Commonwealth Bank. Why would I buy gold? And it's periods like the last 3 years that kind of explain why you need hedges. And I was quoted in an article this week as well, which is talking about the crisis. And one of the things there was, in periods like this, you're not going to bring up that article, hopefully.
What was the article?
No, it was the Golden Times. Basically, we were talking about how what's happened this year is the things that were underperforming last year have actually done well in a small period, like in a very small sample size, obviously. But whenever we do portfolio reviews every quarter with our clients, there tends to be a focus on the things that have lost money. It's always, what's the biggest red and why has that happened? And sometimes gold, sometimes it's bonds, or bonds have done zero rather than up 20%. But this is exactly the time where you want those things within your portfolio, because they are less correlated. They're not always, perfectly inverse correlated, but they are less correlated. And the things that have underperformed when markets are good generally do better, or not as bad when markets are bad.
That's if you look at this, for those that aren't looking at the screen.
Look at that chart. That's a nice chart.
Over 1 year, the Global X Gold Bullion ETF, GXLD, which is their new gold in US dollar gold, is up 42%. So
that's up from, if you go back, that's like $3,200 an ounce, where everyone thought it was expensive and going to fall to $55,000 an ounce.
Even the currency hedge version from BetaShares, which is QAU, is up 30.5%. So, wow. Incredible. Really good stuff. We do have, how long have we been going for, Drew? Jeez. We do have time for some questions here that have been sent in, so please send in your questions for next week. We'd love to hear your questions. Just follow the link in your podcast player or on YouTube, just in the YouTube description there, select questions and select the question, the show, that is the Australian Investors Podcast. So there are some good questions in here. So this is from Mick, formerly known as Bo Tom Picker Gets Smelly Finger.
I don't think you need to write that one out. We get it. It's a play on another one, isn't it? I can't remember what that was.
Anyway.
Something about scratching. I'm not sure.
As an ETF investor and fan of Rask, I'm fascinated by the present global markets, aren't we all? I've tended to focus on building my core portfolio through ETFs that represent good fundamentals. But in times like this, do you switch the balance towards macro investing, especially for international ETFs? Cheers. That's a good question, Mick. So Drew, do you change from fundamental ETF investing to
You mean that's
macro?
like cheap companies, or is that what we think fundamentals mean in this case?
I think what Mick is referring to is maybe looking for ETFs that have like low price earnings ratios, high dividend
fundamental
yield,
value almost.
that sort of stuff. Yeah.
And then macro being like global growth.
Rates,
I
maybe.
feel like it's,
or maybe it's geopolitical stuff like no US, more Europe kind of thing. Anyway, do you do either of those things?
I think it's important to know your purpose and what you're investing for. Because what I hate seeing is that when something like this happens, we somehow create a new strategy. Like we've been investing a certain way for 3 to 5 years, but it's like, just had the quickest sell-off since the global financial crisis. I got to change. It's like, if that's your approach to investing, you probably need to go back down and work out what your framework is and what your objective is and how do you stick to it. So if this is triggering your need, another word, triggering, your need to review or change your portfolio completely, it probably means what you were investing into, the way you're investing wasn't really attuned to what you were trying to achieve in the first place. I'm not saying that you have to, we invest for retirees, so we have to prepare for resilience. We have to have heaps of diversification. If you're investing for growth, you don't have to worry you should have diversification, but you don't necessarily have to worry as much about asset allocation to the level that we do because you've got a longer period and asset protection. But I think you should always be including both of these within portfolios to a level. And the key is just not being triggered by changes like this occurring. This should be a time that you're just continuing what you're currently doing. And if you've got additional cash like you did, deploying it, but also being wary that maybe deploying it all at the same time isn't also the best idea. That these crises can, this is a very short one so far, but they can drag on and on and on. I thought the Ukraine-Russia event would last like 3 weeks and it would have no impact, but it actually had the biggest impact on global supply chains.
That's the big one. That's what people are underestimating, in my opinion, is like the tariffs will cause inflation. It's just a matter of where, how much, and for how long. And that's the real problem, is if these tariffs and reciprocal tariffs and global supply chains are interrupted for 2 or 3 years. Quick bit of pop trivia for you, Drew. So the FTSE 100, like most things in the UK, has had a miserable time. Last year, it was kind of showing signs like it was relevant, and then all of a sudden fell straight off a cliff a few days ago. My pop trivia for you is, name one of the 5 biggest stocks in the FTSE 100.
BP. BP.
Well, that's pretty good. I was going to say Standard Chartered. Now let's have a look.
Yeah, Standard Chartered, HSBC.
Is that?
Hong Kong, Shanghai, no, maybe not. But definitely British Petroleum. Like, come on.
Okay, let's have a look. Holdings in the beta shares. AstraZeneca is the largest one, followed by Shell. Oh, you're right. HSBC.
There we go. I think I remember this because I did that episode when we did that episode on concentration risk, and there's actually I think it was 46% concentration is the top 10 in the UK. And look, and the biggest holdings are all healthcare or energy, looks like. Yeah.
And then the 10th one is the actual stock exchange, London Stock Exchange Group.
Wouldn't say that at the ASX.
Yeah. Interesting. Oh, Rio Tinto's in number 13. BAE. Yeah. Diageo. Okay, so what did I say? I said Standard Chartered. That's not even in the top 20. Shows what I know. But my point is, a lot of people were saying the last couple of weeks, get out of the US, go to the UK, or Europe. FTSE 100's down 3.5%. What's the CAC 40? That's the
I go to China.
Exchange. 15% down over the past year. Hang Seng, is that what you said?
Yeah.
Hang Seng over the past year, 20% positive. Geez, look at that.
Even with that sell-off.
Wow. That's
China, domestic China has been performing reasonably well.
Yeah, what's the China A-shares index? Is that the CSI 300?
I think so.
6%, but had a massive pop last year. Wow. Yeah. Okay. So 5 years? Oh, not good. So does it make you think, with all this tariff stuff in the US primarily, well, maybe we shift the mix to more towards Europe?
I don't think it's warranting enough yet. And you saw what happened with energy prices, I think, at the same time. if the FTSE was it OPEC Plus announced supply increases at the same time as all the tariffs were happening. I think the US dominates the world in pretty much every industry and in the index as well. So I think your core is always going to be US heavy. That's what you do in your satellite. And Europe, there's still so many challenges. Europe is so diverse, and it's hard to get too granular. I know some of the best ways we've accessed Europe are actually through a small cap fund that's investing into some smaller European companies as opposed to a big broad index. Because it's just like same as the US, talking about 10 huge companies that are driving the market. They're very different to everything else. I still prefer, like Asia, still, you can see Asia's performed reasonably. Even with what's happening in China, the China shares have held up reasonably well, particularly the kind of domestically focused ones, not the exporters.
Yeah. Hey, question for you. I did a bit of pop trivia before in terms of the biggest English companies. Let's go for some of the biggest European. So overall, what would you say? So we know AstraZeneca is the one from the UK. We're in the top 10. Oh, we're at top 5. What's in the top 5?
LVMH.
Number 1 from France.
Just. There's going to be a Roche. No. Estee Lauder. There's going to be some what's a healthcare company? Sanofi.
Sanofi's 22.
Yeah. Biggest healthcare companies in the world. Pharmaceuticals. Novo Nordisk.
Yes, Novo Nordisk is 3rd.
I always get commented on my memory for random useless facts.
Random facts of the world.
My 6-year-old son's at a similar.
Dad,
yeah.
What's the biggest companies in Europe? Oh my God.
He'll be listening right now. He'll remember them too.
Number 2 is SAP.
Yeah.
Number 4 is Hermes, the luxury brand.
Yeah. Oh, pronounced well too.
Thank you. I had to Google that the other day because there's an Hermes store near the Water Partners.
There is around the corner, but so Chanel and Dior and everything else.
Nestle's number 5. So wonderful companies. Don't get me wrong. ASML, obviously one of the world's most important businesses right now. L'Oreal.
Very narrow.
Yeah, it is. But there's some really, really good companies. Accenture, like HSBC.
Like if you put all the 3 big indexes together, you could actually end up getting a spread of sectors. You get healthcare and consumer in Europe, you get technology and maybe energy in the US, and you get materials and banks in Australia.
Yeah, it's crazy. So the biggest European company is $296 billion. What's the biggest American company?
Biggest American company?
Yeah.
Has Apple taken over NVIDIA?
It's $4.8 trillion, Apple, versus the biggest company in Europe, which is 290. In fact, if you went through America's list of companies, even in the top, you would have to go down to position 43, which is Morgan Stanley, to get to a company that is the equivalent largest company in all of Europe.
That's
and
massive.
So people often say, do you need to be more diversified? Yeah, maybe, but there are so many good companies in the United States, software companies, healthcare companies, industrial companies, manufacturing companies, financial companies, creative companies. Like even Walt Disney's the size of Europe's biggest company. So like I often think that I get it, but I think that this whole thing of American exceptionalism, I think it's still there. I just think it's in the companies, not necessarily in the railroads and the those types of businesses. But I think it's in these beautiful tech and industrial companies. Costco. Speaking of Costco, I said to the community, the Rask community yesterday, that I was going to buy some Costco shares and some WiseTech shares, Drew, just a little bit, because I wanted to buy these companies. And sure enough, Costco jumped about 10%.
Straight away.
So I still plan on buying a very small amount, and we'll just see how it goes. But I didn't know Costco is the 17th biggest company in the world, which is remarkable for a supermarket.
It's huge. And guess what? I didn't send you a photo of that.
What?
We went.
You went to a Costco?
Yeah, date night.
Oh, wow. How did that go for you?
Very, very well.
Okay.
It's quite exciting.
It is.
As long as you plan ahead. You have to go with the plan.
Otherwise, you end up with a truck delivery.
$800 worth of stuff.
Yeah. Okay, so here we go. This is an interesting. What is this question? This is from Orangey McOrangeface. Hypothetically, if there was a meme-named agency that is looking to cut jobs at agencies that investigate fraud, and me and my rich pals had some spare change, maybe also some funds from a recent meme coin rug pull, and I could make the markets go up and down, how easy or difficult would it be to buy the dip through a complex structure and remain anonymous because I am modest? In brackets, readjust tinfoil hat. Is this person talking about Chamath?
Saying a conspiracy theory. I hate conspiracy theories.
Yeah, I mean, who knows? How hard would it be? It'd be very, very hard.
To do it without going to jail.
What this person is alluding to is that someone like Elon Musk or Donald Trumpy Trump could somehow move billions of dollars throughout financial markets and not get noticed.
Regulators are pretty on to this. Like if there's a huge amount of volume that happened the day before the 3-day sell-off in Trump's Liberation Day, outside normal volumes, there'll be investigation. There'll be immediate investigations or ongoing, all kinds of prompts to do that.
Imagine so imagine you're Elon Tusk and you've got what's your net worth, Drew, if you're Elon Tusk?
800 billion.
Okay. Well,
it's up 22% overnight. I can't remember.
Okay. So say you're Elon Tusk, you've got $359 billion, right? Most of that is in SpaceX. We know that because he owns about 40% of SpaceX, and Tesla he owns like 20 or 30%. He is not able to sell $100 billion of Tesla to then go, right, Trump, now's your turn. Drop the markets. I'll reinvest in 10 days. Who the heck is going to buy $100 billion of his stock?
No one.
No one can afford to buy it.
Surely you would have sold some Tesla before that happened.
And secondly, then you're like, oh, well, maybe he'll do it with $1 billion. Why would he risk going to prison for 0.3% of his wealth? He wouldn't, is the answer. So that doesn't happen. And even if you could do all of that, you still need to put the money through a financial system, which would mean that the records of the shares and everything need to be tied to you. So these conspiracy theories are absolutely wonderful to poke fun at because they're absolute gibberish. All right. Here we go. Daddy New Money says, listening to your show has inspired me to take the plunge into the world of investing. I've set up a monthly automated investment into some ETFs through BetaShares Direct. Disclosure, sponsor of our finance podcast. I am wanting to set up accounts for my 2 children, 9 months and 2 years, to give them a head start in adulthood. What platforms offer these types of accounts? Thank you both. Keep up the great work. We've spoken about this before, Drew, how to set up kids' accounts. There are basically 3 options. 1, in your own name or your partner's name.
Yep.
That's 2. You can hold it in your legal name, but on their behalf with their tax file number. And that has tax consequences, which are good and bad. And 3, you can use a family trust, basically. And a family trust is going to cost you about $4,000, $5,000, depending on how you set it up. The way I'm investing, I'll just cut to the chase. The way I'm investing for young Charlie is probably going to be through our family trust, maybe with some individual shares off to the side. He doesn't have a tax file number. He's 2 weeks old. He doesn't have a birth certificate. So I'm just going to do it through that. I'll probably consider an investment bond in the next 3 years.
Yep.
That won't be all of the money.
An education bond or
Yeah, education bond. I'll consider one of those, but it won't be for all of the money. You can open an education bond with $2,500. For anyone's benefit, we had Grant Hackett on the show recently. You can go back and listen to that episode with him. But basically, it's a different tax structure. I think parents get way too caught up in tax and
if you've got an entity structure, just do it as it is. I feel grandparents tend to, maybe it's better doing it as trustee for when a grandparent does it. But for parents directly, you may as well be, dealing with your own wealth and then having a portion of that to put towards your children at some point in the future.
Yeah, I think one of the things, Drew, though, tell me what you think about this, because you deal with a lot of retirees, and particularly a lot of retirees with a lot of money. do you like gifting rules in Australia are pretty loose at the moment? So you can gift your kids money. So you could draw money out of super, say before the grandparent is going to pass away or the great grandparent, and gift that to your kids. Or you could just simply gift money to your kids for a first home deposit or something like that. Do you think that we'll see that change over the next 10 years?
I don't think. I think it's more likely to, you've got to have an inheritance tax before you start getting rid of inter-family gifting. And it's probably much easier to tax inheritances than it is a gift. I think it's hard to see a gifting tax. And I mean, even harder to see an inheritance tax in the short term, but you never know, what kind of policies any government's going to run on. So, but gifting tax, I think, will be fine. There's a gifting tax if you're on the age pension where you can only give away a certain money. You can't, give money away to then increase your age pension. But I don't think it's enough money is kind of disappearing because most of those cases it's going into something that's going to be taxable anyway. The government's more worried about, where it's going somewhere that isn't taxable.
Yeah, true. Yeah. But if you can tax penguins, like Donald Trump proved this past fortnight, maybe you could tax retirees even more than Australian governments.
Who knows? Topic for a new video.
Yes. There was a debate this week, just so you know, in our Australian politics, but no one watched.
I didn't even know that was on.
So final question comes from Portfolio Pirate. Actually, there was a pirate in Australia. Remember that guy that named Stuart McAuliffe? He named all of his listed investment companies after pirates. He was investigated by ASIC and went through the courts. That's all I'll say. G'day, mates. I've been investing now for a few years, most exclusively through an index ETF approach. I have now started branching out into individual stocks. Branching out, that's interesting. My question is, if I wanted to start investing into CBA, for example, but there are already an ETF that I currently hold, or they're already in an ETF that I currently hold, is this something you could do if you wanted to increase the percentage of the company in your portfolio? Or would it be best to let the ETF do its thing and invest in individual stocks that might not be wrapped up in the ETFs you currently hold? They go on to say, I also just want to say a quick thank you. I have been listening to the finance and investing podcast at Rask for at least 3 years now, and the knowledge I've gained has completely turned my life around. I wish there was a compulsory finance class in high school for everybody. Take care. That's a hell of a question and a very kind note, Drew. So the question is, adding stocks that might already be in your ETFs or your managed funds. Thoughts?
I think the key here is knowing what your objective is, again. Like if you think about this, I wouldn't be just adding CBA next to my 7 ETFs. I'm running my core through ETFs and maybe I'm using the share portfolio as a satellite, but you want to know, how many stocks am I buying? Am I actually trying to build a diversified portfolio or am I just taking a really big bet on 1 or 2 stocks? So you want to know when it's just one, am I holding 10 to 15 stocks? And that's going to look a lot different to the index. Then the question would be, am I replacing my core with direct stocks or am I just complementing it? And there's no, the index has 10%. And if you're holding multiple ETF, 10% in CBA, if you're holding multiple indices, then your portfolio is still probably going to be not heavily exposed to CBA. If you think about it, it's not going to have 20 or 30 or 40%, depending on how large that position is, particularly if it's in a diversified portfolio. And you can get super complex. You can go by the ASX, X banks and resources, and then buy all the banks and resources directly. But in my experience, just get the core right. If you're fully indexed, fine. If you're indexed at active, fine. And then have a framework around what direct stocks you're buying. So we have basically at least 2 stocks from every sector in our direct share portfolio is the way we do it. And it's all within the ASX 200. And that replaces a core. And then you can add other things around that, small caps, micro caps,
that's cool.
Thematics.
That's cool. I actually just noticed as you were talking there, in the room behind you there, you've got the book Traction by Gino Wickman, which I've got over my shoulder, Traction by Gino Wickman. This is like a conspiracy. You're being invaded by Gino Wickman.
Yeah.
Good book though for people that run a business. Probably the book, to be honest.
For sure. Haven't finished it yet. Started to get through it.
Very, very practical guide to running a business. If everyone read that book before starting a business, the percentage of businesses failed would be cut by like 80%, easily. So I think about this in a similar way. I think like if you're going to have your core done, you can have a completely different brokerage account, set up different Navexa tracking for that one portfolio, the core or whatever platform you use if they do tracking. And you could track your two portfolios. You could have your core and your share portfolio. And who cares what's overlapping? Just see if your individual stock investing is working. And if it is, or if it's not, even if it's not as good as your core, but it's kind of there and you enjoy it, keep doing it. The key thing is to track it, Drew, I think. And that overlap thing, that's an issue for sure. But I'll give you a story of a fella that used to appear on this show very, very, very regularly. And he was one of the people that kind of motivated me to get a Tesla. He had about, I believe he would have had somewhere between $5 and $15 million invested in Tesla shares. And it was significant, right? It was significant and a massive, massive part of his wealth, massive. But he wasn't phased. He had it would have been significant, right? But he wasn't phased because he had multiples enough that he could retire on. But crucially, he was fully aware of the risks. He understood the decision that he was making, that plan that you so aptly speak about. And interestingly, most people aren't in that scenario where you've got 10 mil or 5 mil in an individual stock, at which point you would build a portfolio around that. You wouldn't keep adding to that position most likely, but most people aren't like that. And so a little bit of overlap is fine, in my opinion. This is general advice only, of course. Now, Drew, we have come to the end of the show. Almost an hour on the clock, my friend. You need to go pick up your Prado, which is very exciting. So if anyone sees a white Prado driving around Australia, just have your
Don't crash into it.
Just have your
Munger, come say hi.
Yeah. Just be like, you're the guy who owns that stock.
I need a little Rask sticker for the bask. Rask sticker.
Yeah, need to get a couple. If it's got a Waddle Partners, a big W in the window, then you know what's up.
Yeah.
Drew, you need to give us your dad joke. I need to.
I had one ready this time too.
Oh, right, okay. I think everyone that wrote in this week is particularly good. But if you were the person that wrote in Portfolio Pirate, I love this question because I also love the sentiment that was on the back end of it. Thank you for making the most of the Rask podcast. And if it has changed your life, that's fantastic. And that's exactly why we do these things. Obviously, it supports our businesses too, but it actually is, we love doing it. And today there was an abnormal amount of banter just to try and calm everyone's nerves. But we love this question. So Portfolio Pirate, right into us. You can get a free value investor program. Just any of the Rask websites. Keep your questions coming, ladies and gentlemen, for next week because we will be back talking heads on the 2 cents segment every Saturday at 7 a.m. Now, before Drew gets to his dad joke, don't forget you can get financial planning by heading to the link in your podcast player or YouTube description. Drew's face looks surprised. You can get financial planning in there. So head to the link in your podcast player. You can also access a bunch of other resources like courses and so many other things. At this time, I think right now in stock markets over the past 3 months, and who knows what the next 3 months hold, is exactly the time that a financial advisor pays for themselves, often to the tune of multiples of the fees that they charge you. Everyone, during the good markets, everyone's like, why do I need an advisor? And then all of a sudden, the you-know-what hits the fan and everyone's like, oh.
Maybe I'll switch options now.
Yeah. So
let's hope not.
Yeah, we joke, but the amount of people that wrote into me, Drew, this week that said they were considering moving to cash. Actually, there's a community poll on this. It was scary. I did do a poll this morning, and 43% of the Rask community bought more shares or ETFs this week, or managed funds. They invested more this week, 43%. 52% held firm, so no buys or sells, and only 5% sold.
That's good. Educated community. Even it doesn't. I think I'd prefer to see more people do nothing, but a good portion buying isn't a bad thing.
It's probably just dollar cost averaging for a lot of them, to be honest.
Exactly.
Right, Drew, dad joke.
Here's a good one for you. Is this pool safe for diving? It deep ends.
Oh my Lord.
I hadn't had it depends this week, so I just had to throw one in there at the end.
Is so good in multiple ways, Drew.
Yeah.
It depends is the ultimate answer to anything. It's a good way to end the show. Drew Meredith, good luck with your Prado. Good luck up in the high country. Hopefully we'll see you safely home next week. And thanks for joining me.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.